What's going on, everybody? Happy 5th of July today. Back in the office, back to reality. Hope everybody had a great 4th. I actually headed up to Taylorsville, California, did a little bit of roping over the weekend. It's a beautiful spot up there, getting to rope in the middle of the trees in the forest, and there's a river that goes by the arena. It's just absolutely beautiful. So I had a blast out there, and then I actually spent the 4th of July, the actual yesterday, I guess, in Lake Tahoe. So been pretty spoiled with some nice weather, avoiding the heat that we've been having up here in Northern California. For my Arizona clients, you probably think that I'm a big weenie for thinking even a little bit that we're getting hot up here compared to you guys, but all has been well. I hope that you guys had a fantastic 4th and wanted to jump on here, give our monthly market update for June. We're already halfway through the year here into early July, so got a lot to cover. Wanted to start off, though, believe it or not, with the Fed, right? We've been talking about this for a year and a half. I mean, it's been the same narrative for a while, but it really is one of the main things that's driving the market. So we got to keep talking about it. Basically, again, we're trying to get to that 2% annualized level of inflation. That's what the Fed has been fighting for a long time. We've had big inflation issues, and we've been talking about it for a while. So this last meeting that the Fed had, they actually decided to pause their interest rate hikes. Now, that's much different than stopping. They're basically just taking a quick step back, letting the dust settle, see what everything looks like with just a pause. But I actually wanted to quickly read an excerpt from what they were actually talking about here. Okay, so here we are. Despite the reservations of some officials, the ultimate decision to hold rates steady last month was unanimous. And almost all officials expect more rate increases this year, according to the minutes. That aligns with recent comments from Fed Chair Jerome Powell, who said last week that there is still a risk of doing too little to bring down inflation. So it's a tough job that they have here. I mean, especially with this monetary policy that they're conducting. The hard thing about it is it has a very much of a lagging effect, right? Just by raising interest rates as they've been doing, it doesn't mean that we're going to see the real effects of it the next month or the next 2 months. I mean, it could be a year until we actually see what all of these interest rate hikes are really going to do. Plus, you throw in all the stuff that we were having with the regional banks, with Silicon Valley, First Republic Bank. That was basically another version of a rate hike of what it's going to effectively do to the economy. So I think it's a good move. Take a step back, let the dust settle, see what everything looks like when the smoke clears, then they can decide where to go. Again, Jerome Powell is staying hawkish, though. He is in no way, shape, or form saying, hey, we're out of the woods. We're much closer than we expect, and we're probably going to be stopping rate hikes soon. He's just saying, quick pause. Realistically, they're saying they're probably going to do at least 2 more rate hikes going forward to, again, combat this inflation issue. So we'll see what happens, but that's really what we're keeping a close eye on, is what, the direction that they're leading us in here. So in terms of the market, what's been going on? I want to look at year to date here, actually. And there's certain stocks that have been absolutely killing it. I mean, our NVIDIA's, Apple, Microsoft, Amazon, Google, some of the major tech companies, and have been going absolutely wild. So no surprise there with those stocks doing so well. The NASDAQ, the tech heavy index, is up 38% year to date. It has absolutely killed it. S&P is up a little over 15%. The Dow, which was the main leader last year, if you remember, during 2022, the Dow was the best performer, is up only 3.5% here year to date. And then, so a couple things that I want to point out. One of the main changes that we've made to our portfolio has been on the bond side of the portfolio, which, it sounds interesting because we don't talk about the bond side of the portfolio as often because it's normally there to just kind of keep the ship heading in the right direction, hit a bunch of small singles and keep things afloat, right? And counterbalance when we're heavy on the stock side. We want to have that counterbalance. So when the stock market is performing poorly, bonds normally perform well. But getting kind of deep into the weeds of what we've been talking about within our investment committee meetings and what we're doing specifically with our bond portfolio is we're adding duration. So what does that mean? Well, before we've been talking about a position called Pulse, which we still hold. It's PULS. That's a short duration bond fund, 30-day bonds and less. And so if you remember, when we've talked about this before, when interest rates go up, the price of bonds go down. So in a rising interest rate environment, we don't want to hold long dated maturities, because the longer the duration is, the longer the date to maturity is, the greater change in price with the change in interest rates. It has a larger effect. So Pulse did really well last year. It was basically a cash equivalent that did better than just sitting in cash. But being that we believe, and the Fed is flat out telling us, we're closer to the end of the rate hike cycle than the beginning. So what does that mean? At some point in time, we're going to hit a point where we're no longer raising interest rates, and historically we'll actually hit a point where they're going to start lowering interest rates again. So in order to take advantage of that, we have added duration to our bond portfolio. So going less into 30-day and less bonds, and more into like 10-year bonds, right? So as interest rates start to slow down, the increase in interest rates starts to slow down, and potentially at some point even reverse course and have some rate cuts, long dated bonds should do extremely well. I mean, we're even forecasting that over the long run here, our next couple of years, we may be able to get some equity-like returns out of our bond portfolio, which is not normal, but we're trying to take advantage of this interest rate environment that we're in. So that's this LGOV play that you're going to see in all of your accounts. And we're, kind of for the time being, that is a long-term hold for us. A couple other changes that we've made to the portfolio that you've probably seen is adding some bank stocks, adding some plays within the financial sector. We have included Huntington Bank, we have included Charles Schwab, and we've included KeyCorp. All of those, or at least Huntington Bank and KeyCorp, are smaller regional banks. So you might be thinking, okay, weren't those the ones that were going bankrupt and having all the problem? Why would we buy into some of these regional banks? Well, if you remember, if you don't, go back and watch the last market update that I sent and went through the entire process and reasoning of why Silicon Valley and First Republic were having the issues that they were having. KeyCorp and Huntington Bank were not invested in the same manner as First Republic and as Silicon Valley. They didn't just hold long duration bonds. They actually have enough excess cash to, if it were to happen, to cover the withdrawals of their clients. So there's zero possibility of a bank run. They don't have any margin pressure there. And actually, the price that their stock is trading at is lower than the intrinsic value of their business. So if you think about it, they could go out and sell their business for more than their stock is trading for, which makes no sense. I mean, when you look at, most companies, when you think of Apple and Amazon and Google and all those, they're trading at very, very high multiples of what the company is actually worth. So the valuation and the screening that we go through to pick these companies, the valuations are just unbelievably optimistic at this level. Now, just because the valuation is optimistic doesn't mean the timing is always perfect. So we got into these positions a couple of months ago. And honestly, looking back, hindsight's 2020, but it was a little bit too early. There was still a little bit too much pressure on these regional banks just from all of the rhetoric out there in the news, and they've had some downside volatility. But just because of that short-term downside pressure does not change our conviction on why we bought these as a long-run play. We are currently very willing to accept a little bit of this downside pressure, knowing that we have humongous upside on some of these plays. So year to date, obviously we weren't in them for the entire year, but they've been beat up hard. Looking more at a 6-month window, or let's look at a 3-month window, because that's more realistic to when we bought them. Charles Schwab has done really, really well, up about 14%. Looking at Huntington Bank, relatively flat. I mean, down 30 basis points. It hasn't done a whole lot. KeyCorp has gotten hit pretty hard. They're down about 17%. So looking at what we're kind of thinking moving forward, both Huntington Bank and KeyCorp have their earnings calls coming up here at the end of July. So we're going to be keeping a close eye on that. So if we hear something fishy or something that we're not expecting, that would trigger us to sell those positions, but we really don't expect any negative news. Actually, we think that there's probably going to be a bump after their earnings call, but time will tell. Another thing that could make us sell those positions is if we get more than 2 rate hikes. 2's okay. More than 2 is probably going to put too much pressure on these smaller regional banks, and at that point in time, we would sell them. But for now, again, there's no reason to change these positions. We're still very, very bullish here, and we're going to be holding them for the foreseeable future. The rest of the portfolio is similar to what you've been seeing all year round. Our core positions. We did change our large cap growth fund. So its ticker is DUSLX, I believe. I might have mixed up one of the letters, but we did change that to get a little bit more upside in the large cap growth space, but everything else is relatively the same. Just wanted to give you an update, why we changed our bond fund, why we're going longer duration. So you can keep an eye on that if you want to, and kind of our conviction and thought process on the regional banks here. KeyCorp actually lately has had a really good run. Looking at just month to date here, everything else is relatively flat. I mean, from negative 70 basis points up to only 16 basis points. Not a whole lot of action. KeyCorp is up 3% here over the last month to date. So again, showing that from a valuation perspective, we're really excited about these ones. It hasn't paid off quite yet, which has made honestly our portfolios lag a little bit below the benchmarks. But that's another thing to keep into consideration, right? I mean, just because year to date, the S&P is up 15% doesn't mean that that's the goal of your portfolio, right? We have to balance the thoughts between fear and greed, right? It's hard to do. I mean, just from a behavioral economic standpoint, when the market's going up and rallying, everybody wants to be in the most aggressive portfolio possible and get the most bang for their buck. And when the market's falling, everybody wishes they were in the most conservative portfolio. But that's why we go through the financial planning process, because we can't be changing these allocations all the time. We have to have our long run in mind and stick with it. So again, we're going to be having these conversations. I'm going to be reaching out to all of you guys that are clients and setting up our semi-annual reviews. It's that time of year again. So we'll talk about what your allocation looks like, make sure that it still fits and aligns with your goals, and make sure that you have the correct risk tolerance set up for your financial plan. So hope that helps. Hope that gives a little bit of insight into what is going on. Again, expect these phone calls to be coming out here starting at the end of this week and early next week to start setting it up, all of the appointments to meet with you guys for that semi-annual review. But in the meantime, as always, if you have any questions at all about anything I talked about or anything about the market, your portfolio in general, call me at any time. Happy to chat about it, but I will be doing those one-on-ones with all of you guys here shortly. So again, hopefully you guys enjoyed your 4th. Maybe some of you are still having a long vacation, so enjoy the rest of the weekend and the weekend, and I will talk to everybody soon. Have a great one, guys. Talk to you later. Bye.